At the recent PERE family office event in Singapore, we discussed this trend of growing capital coming into real estate and how that will affect transactions moving forward. As we've seen in other asset classes over the years, the more capital that comes into the sector, it drives different behaviours and different ways of transacting real estate.
At a country level within Asia Pacific, we're seeing Japan and Australia continuing to dominate the cross-border activity. So like 2014, 2015, we'll see Australia and Japan accounting for well over 50% of the investment volumes. So that's making competition for assets in those countries very fierce. At a city level, globally, we continue to see cities, and particularly global gateway cities, dominate. So the top 30 cities account for over 50% of global investment volumes. So whilst countries are obviously seeing strong activity, actually much of that activity revolves around a relatively small number of cities globally.
With the rising liquidity that we've seen in real estate markets over the last few years, we've already seen the significant effect it's had on pricing, particularly in core markets. And we now see that rippling out into both secondary locations, but also into secondary assets and tertiary assets with more value add and opportunistic strategies coming into the market.
So at the recent PERE conference, diversification was a central theme as a key driver for cross-border activity. Diversification, particularly here in Asia and Singapore and Hong Kong, is investors wanting to invest outside their domestic markets. I guess not to keep all their eggs in one basket, if you like. Diversification also means that we are seeing investors looking to go up the risk curve. So they're looking at value add, sort of core plus opportunities, so taking more risk as core assets become more expensive. So it's both diversification from the perspective of moving outside their home markets, but also diversification in terms of taking more risk as the core markets become more expensive.
Well, the impact of rental growth on markets is particularly key going into 2016 because we've probably seen as much performance on the capital side as we're going to see. So rental growth coming through is particularly important. Obviously, those markets that haven't seen much development are probably going to see more rental growth over the next 12 to 18 months. Those that have seen more building, more new office space, more new retail space being constructed will probably see more moderate rental growth.
So in the fourth quarter, we expect very strong transaction activity across the three regions. We're forecasting at this stage that could result in around 750 to 760 billion US dollars of transactions for 2015, which would make it a record year. So really, that is reliant upon vendors and buyers closing deals between now and the end of the year. And there's strong motivation on both counts, which I think will see us hit those numbers by the end of the year.